Welcome, ladies and gentlemen, to Boss Economics World, the only place where we slice through the economic baloney, dice up the financial fluff, and serve you the raw, unfiltered truth about what's really going on in the wild world of money. I'm your host, the one, the only, boss economist extraordinaire, here to break down the madness, the mayhem, and the moolah behind today's hottest economic headlines. So, buckle up, grab your calculators, and let's dive headfirst into the glittering, golden mess that is, gold prices in 2025. Now, folks, if you've been paying attention to the markets, and let's be real, if you're watching Boss Economics World, you're either a finance nerd or someone who's just here for the chaos, then you know gold is having a moment. As of August 14, 2025, spot gold is trading at a jaw-dropping $3,372.03 an ounce, up 0.5% in a single day, and, get this, up a whopping 28% for the year. That's right, gold is shining brighter than a TikTok influencer's teeth, and it's all thanks to a perfect storm of economic shenanigans. But what's really going on here? Is this a golden opportunity, or are we just fools rushing into a glittering trap? Let's break it down, boss economic style, from the surface level sparkle to the deep, dark economic underbelly. First up, let's talk about the shiny, surface level story that's got everyone buzzing, the Federal Reserve and its magical interest rate lever. On August 13, 2025, Treasury Secretary Scott Bessent, yes, the guy who's supposed to be the adult in the room, came out swinging, saying the Fed's benchmark rate should be at least 1.5 percentage points lower than it is now. Translation, folks, he's basically begging the Fed to slash borrowing costs faster than you can say, quantitative easing. And guess what? The markets listened. Treasury yields tanked, bets on a September 2025 rate cut skyrocketed, and gold, oh, sweet, shiny gold, jumped for joy. Now, for the uninitiated, let me break this down in plain English. Gold doesn't pay interest, right? So, when borrowing costs are high and treasury yields are juicy, investors ditch gold faster than a bad Tinder date. But when yields drop and borrowing costs get cheaper, gold suddenly looks like the belle of the ball. And right now, with the market betting on a quarter-point rate cut next month, and some even whispering about a half-point cut, gold is strutting its stuff like it's 1979 all over again. But hold up, folks, let's not get too starry-eyed just yet. This isn't just about gold being the pretty girl at the prom. There's a deeper, darker story here, and it's all about what these rate cut bets are really telling us about the state of the economy. Spoiler alert, it ain't pretty. Alright, let's peel back the glitter and get to the grime. Why is the Treasury Secretary practically on his knees, begging the Fed to slash rates? Why are markets suddenly pricing in monetary easing like it's Black Friday at the discount store? Simple, folks, the US economy is starting to look shakier than a Jenga tower in a windstorm. First, let's talk data. According to the latest figures from the Bureau of Economic Analysis, US GDP growth slowed to a measly 1.8% annualized rate in Q2 2025, down from 2.5% in Q1. Meanwhile, the Conference Board's leading economic index, a crystal ball for economic activity, has been flashing red, declining for 3 consecutive months as of July 2025. And don't even get me started on the labor market. The unemployment rate ticked up to 4.6% in July 2025, the highest since mid-2022, while job openings fell to their lowest level in 3 years, per the latest JOLTS report. Translation, businesses are hiring less, consumers are spending less, and the economy is slowing down faster than a sloth on a coffee break. Now, here's where it gets juicy. Remember inflation? Yeah, that pesky little monster we thought we'd slain back in 2023? Well, it's rearing its ugly head again. The Consumer Price Index, CPI, rose 3.7% year-over-year in July 2025, up from 3.2% in June, driven by, you guessed it, skyrocketing energy and food prices. And why are those prices going up? Oh, just a little thing called geopolitical chaos. With tensions flaring in the Middle East, oil prices have surged to $95 a barrel as of August 2025, the highest since 2022, according to the U.S. Energy Information Administration. Meanwhile, trade wars are back in vogue, with President Trump threatening tariffs on everything from Chinese electronics to, wait for it, gold bars. More on that in a minute. So, let's connect the dots, folks. The economy is slowing, inflation is creeping up, and the Fed is stuck between a rock and a hard place. If they don't cut rates, we risk a full-blown recession. But if they do cut rates, they could stoke inflation even further, turning the US economy into a stagflationary nightmare straight out of the 1970s. And guess what? Gold loves this kind of chaos. When the economy is a mess, investors run to gold like it's the last lifeboat on the Titanic. Which brings us to our next point. Now, if you thought this was just about Fed policy, think again. Gold's 28% surge in 2025 isn't just about interest rates, it's about the world going absolutely bonkers. Let's talk geopolitics, baby. From the Middle East to the South China Sea, tensions are hotter than a jalapeno in a microwave. Just last month, Iran and Israel exchanged missile strikes, sending oil prices soaring in global markets into a tailspin. Meanwhile, the US-China trade war is back with a vengeance, with Trump threatening 25% tariffs on $300 billion worth of Chinese goods, according to a July 2025 White House press release. And don't forget Russia, which just slapped export restrictions on rare earth metals, sending tech stocks into a nosedive. In times like these, gold isn't just a shiny metal, it's a haven. Investors are piling into gold ETFs faster than you can say, doomsday prepper. According to the World Gold Council, global gold ETF holdings hit a record 3,500 tons in Q2 2025, up 15% from the end of 2024. And it's not just retail investors, central banks are getting in on the action, too. The People's Bank of China added 200 tons to its gold reserves in the first half of 2025, while Russia and India each snapped up over 100 tons, per the latest IMF data. Why? Because when the world is falling apart, gold is the one asset that doesn't care about your credit rating or your geopolitical alliances. But wait, there's more. Just when you thought this story couldn't get any crazier, enter stage right, President Donald Trump and his tariff tantrums. Earlier this week, markets were thrown into a tizzy over whether U.S. imports of gold bars would be slapped with tariffs. For days, traders were running around like headless chickens, driving up the premium for gold futures in New York over the spot price in London. Then, on August 11, 2025, Trump tweeted, that there would be no tariffs on gold. Cue the sigh of relief, as the two markets converged faster than you can say, market manipulation. But here's the kicker, folks, Trump didn't elaborate. And if there's one thing we've learned from the past decade, it's that a Trump tweet is about as reliable as a chocolate teapot. So, what happens if he changes his mind? What happens if tariffs do hit gold imports? Well, for one, it would drive up the cost of gold in the US, potentially creating a two-tiered market where American investors pay more than their counterparts in London or Shanghai. And two, it would fuel even more haven demand, pushing gold prices to the moon. Either way, this tariff drama is just another example of how policy uncertainty is turning the gold market into a circus, and gold, my friends, is the ringmaster. So, what's the takeaway, folks? What does all this glittery chaos mean for the average Joe, the finance bro, and the gold bug watching at home? Well, let's break it down. If you're an investor, gold's 28% surge in 2025 might look tempting, but beware, markets this hot can cool off faster than a popsicle in a microwave. If the Fed does cut rates aggressively, gold could keep climbing, potentially hitting $3,500 an ounce by year-end, as some analysts predict. But if inflation spirals out of control and the Fed is forced to slam on the brakes, gold could take a hit. For the finance pros out there, this is a wake-up call. The economic signals, slowing growth, rising inflation, geopolitical chaos, are screaming, recession risk. It's time to stress test your portfolios, diversify your assets, and maybe, just maybe, take a closer look at gold as a hedge. And for the average Joe? Well, if you're worried about the future, remember this, gold isn't just a shiny metal, it's a barometer of economic fear. And right now, that barometer is pointing to stormy weather ahead. And there you have it, folks, the glittering, golden mess that is the gold market in 2025. From Fed rate cuts to geopolitical chaos, from tariff tantrums to central bank hoarding, this is a story of economic madness, market mayhem, and monetary mischief. So, what do you think? Is gold your ticket to financial freedom, or just another bubble waiting to burst? Drop your thoughts in the comments below, smash that like button, and don't forget to subscribe to Boss Economics World for more hard-hitting economic truth bombs. Until next time, this is your boss economist extraordinaire, signing off. Stay savvy, stay skeptical, and always follow the money.